Imagine waking up tomorrow morning and deciding to withdraw all your money from the bank. You go to your bank, but the bank teller tells you, "We're sorry, your money isn't here." At first, you think they're joking. But the truth is, most of the money in your bank account isn't actually sitting inside the bank's vault. The bank has lent that money to other people. So here's the question. If your money isn't actually in the bank, then how do banks really work? How do they make billions of dollars using other people's money? And what would happen if everyone tried to withdraw their money at the same time? In this video, you're going to learn exactly how the banking system works, from start to finish, in the simplest way possible. On the surface, a bank is just a place where people keep their money. But in reality, a bank is a financial intermediary. It collects money from people who have savings. Then it lends that same money to people who need loans. Let's say 100 people each deposit $1,000 into a bank. That means the bank now has a total of $100,000. But the bank doesn't keep that money locked away in a vault. Instead, it lends the money to people and businesses that want to buy a house, build a factory, or start a business. In return, those borrowers pay interest on their loans. That interest is one of the bank's main sources of income. Now imagine the bank gives you a $10,000 loan. The annual interest rate is 10%. That means after 1 year, you'll have to pay back $11,000. But the bank pays its depositors only 2% interest. If that same $10,000 originally belonged to one of those depositors, the bank pays them only $200 in interest. But it charges you $1,000 in interest. The difference between those two amounts is the bank's profit. This difference is called the bank's interest margin. Of course, banks have other sources of income as well, such as money transfer fees, bank card issuance fees, foreign exchange services, investments, business and corporate services. Now here's another question. Do banks actually create new money? It might sound surprising, but the answer is, to a large extent, yes. Let's say you deposit $1,000 into a bank. If the law requires the bank to keep only 10% in reserve, the bank keeps just $100. It lends out the remaining $900. The person who borrowed the money spends it. Whoever receives that money deposits it into another bank. That bank then lends out 90% of it again. This cycle repeats over and over. As a result, that original $1,000 can end up creating several $1,000s of credit throughout the economy. That's why people say that banks create money. In reality, banks don't print physical cash. What they create is credit. But you might be wondering, what happens if everyone decides to withdraw their money on the same day? This is where one of the biggest problems in the banking system begins. A bank can't pay everyone at once because a large portion of its money has already been lent out through long-term loans. That's why if a large number of people try to withdraw their money at the same time, even a healthy bank can run into trouble. This is called a bank run. History has shown time and time again that sometimes a single rumor is enough to send thousands of people lining up outside bank branches. When people see others withdrawing their money, they start to panic too, and that fear only makes the crisis even worse. What's interesting is that sometimes it's the rumor itself that causes a bank to fail, not its actual financial condition. A bank that might have been perfectly stable under normal circumstances can suddenly become unable to pay depositors simply because too many customers demand their money at once. That's why, in many countries, central banks step in as the lender of last resort. During times of crisis, they provide banks with the liquidity they need to help maintain public confidence. A central bank is different from an ordinary bank. It doesn't open accounts for the public. Its main job is to manage the country's economy. Its responsibilities include controlling inflation, setting interest rates, printing money, supervising banks, maintaining the country's financial stability. If the economy starts overheating, the central bank raises interest rates. If the economy falls into a recession, the central bank may lower interest rates so people and businesses are encouraged to borrow more. In many countries, the government insures bank deposits up to a certain limit. If a bank goes bankrupt, the government reimburses a large portion of people's deposits. Of course, that limit varies from one country to another, That's why keeping your money in a bank is usually much safer than keeping it at home. But no financial system is completely risk-free. That's why banks are constantly monitored and regulated. Almost all of us use a bank card every single day. To buy a coffee, pay a bill, shop online, or even withdraw cash from an ATM. But have you ever wondered what actually happens behind the scenes during those few seconds when you tap or insert your card? You might think the machine simply deducts money from your account, but the reality is much more complicated than that. Let's go through it step by step. Step 1. Your card is identified when you insert your card into the terminal, tap it contactlessly, or enter its details. The system reads important information such as your card number, expiration date, and a security code. If your card has a chip, it also generates a unique encrypted code specifically for that transaction. That's why chip cards are much more secure than magnetic stripe cards. Step 2. The request is sent to the bank. The card reader doesn't decide whether the payment should be approved. Instead, it sends the request through the internet or banking networks to the bank that issued your card. The request includes information such as the purchase amount, the merchant's ID, the time of the transaction, and security details. The message reaches the bank in just a fraction of a second. Step 3. The bank makes a decision. Once the request reaches the bank, several checks are performed almost at the same time. Is the card valid? Has the card been blocked? Is there enough money in the account? Is the PIN correct? Does this transaction show any signs of fraud? If all of these checks pass, the bank approves the transaction. But if even one of them fails, the payment is declined. Here's something interesting. When the terminal displays "payment successful," the money usually hasn't been transferred to the merchant's account yet. Today, you can send money to someone on the other side of your country, or even the world in just a few seconds, all thanks to advances in technology. But it wasn't always like this. A few decades ago, transferring money could take several days or even weeks. People had to stand in line for hours to complete even the simplest banking tasks, and many operations were done manually. Today, banks have become one of the world's most advanced technology-driven industries. In fact, many experts believe that modern banks are now more like technology companies than traditional financial institutions. One of the biggest technologies banks rely on today is artificial intelligence. Every day, millions of transactions take place around the world, and reviewing them manually is almost impossible. Artificial intelligence can detect unusual activity in just a matter of seconds. For example, if you normally make small purchases in your hometown, but suddenly a very large transaction appears from another country, the system may flag it as suspicious and either block the transaction or ask you to verify it before it goes through. Artificial intelligence is also used to evaluate loan applications, assist customers through chatbots, and even predict the risk of loan defaults. Now you know that a bank is much more than just a place to keep your money. Banks are one of the main engines of the economy. They move money from people who have savings to people who need capital. They provide loans, make investments, process transactions, and move billions of dollars around the world every single day. But alongside all these benefits, if there isn't enough oversight, the same system can also lead to major financial crises. So the next time you check your bank balance, you might think about the fact that your money isn't just sitting in an account. It could already be helping someone buy a home, build a factory, or start a business somewhere else in your country, or even on the other side of the world.